So you want to own a private prison. Guaranteed customers. Guaranteed government checks. A captive market in the most literal sense of the word. On paper, it looks like the safest business on earth. No marketing budget, no competition for foot traffic. The state hands you bodies, and the state pays you to hold them. Here's the paradox. The business that profits from human beings never leaving still has to fight every single day to keep them coming in. Empty beds don't just sit there quietly. Empty beds bleed you dry, because the contract that built this empire isn't paid per prisoner. It's paid per promise. Tier 1, bootstrapped. A county jail expansion contract, maybe 200 beds, built and operated for $8 to $15 million. Local sheriff signs off, regional bank finances the build, margins are thin, oversight is thick, and one bad inspection can end you. Tier 2, mid-market. A state-contracted medium security facility, 600 to 1,200 beds, running $40 to $90 million in construction and startup costs. This is where the real operators live. Companies with a few dozen facilities, publicly traded, but still small enough to feel every contract renewal like a heartbeat. Tier 3, institutional, federal immigration detention, or a multi-state correctional REIT portfolio. Billions in facility assets, thousands of beds across a dozen states. This tier doesn't sell prison space. It sells guaranteed occupancy to Wall Street, wrapped in a real estate investment trust structure, paying out dividends built on the assumption that crime, or at least arrests, will never meaningfully decline. Every tier is the same bet, scaled differently. Somebody, somewhere, has to keep getting locked up. The revenue mechanism is almost embarrassingly simple. It's a hotel where the guest never checks out voluntarily, and the government pays the nightly rate instead of the guest. That nightly rate has a name, the per diem, a fixed dollar amount paid per inmate per day, regardless of what it actually costs to feed, guard, or medicate that person. $50 a day, $80 a day, multiply that by 1,000 beds, run it for a year, and you understand why this industry doesn't need philanthropy. It needs population. Which brings us to the metric nobody puts in the annual report headline, but every operator watches obsessively: the occupancy guarantee. Many state contracts include what's bluntly called a lockup quota or a bed guarantee, language requiring the state to maintain a minimum occupancy rate, often 90 to 95%, or pay the company for the empty beds anyway. Read that again. The state can be billed for prisoners it doesn't have. This is the counterintuitive fact that breaks people's mental model of the business. A private prison company doesn't primarily fear crime going up, it fears crime going down. Sentencing reform is a revenue threat. Early release programs are a revenue threat. A safer society from a certain angle on the balance sheet is bad news. The math only works if the beds stay full. So the industry didn't just build prisons, it built a lobbying apparatus to keep the beds full, and pushing mandatory minimums, opposing parole reform, and writing model legislation that coincidentally keeps the per diem checks flowing. Now look at how the building itself is engineered. Because the architecture is doing financial work you'd never notice from a cell block tour. Modern private facilities are built on a design philosophy the industry calls direct supervision, open dormitory pods instead of individual cell blocks. Fewer walls, fewer doors, fewer corridors. It's marketed as more humane. It is also dramatically cheaper to staff. 1 or 2 officers can visually monitor 150 inmates in an open pod, instead of the small army needed to walk individual cell tiers. Every design choice traces back to a headcount to labor cost ratio. Lighting is fluorescent and cheap. Furniture is fixed, molded, unbreakable. Because replacement cost is a line item that gets modeled for the entire 20-year contract term. Even the commissary, the prison store where inmates buy soap, snacks, and phone time, is run at aggressive markups, sometimes structured through outside vendors who kick a percentage back to the facility operator. The hidden liability sitting underneath all of it is staffing. Guards are the single largest cost center, and turnover in this industry regularly runs above 100% a year. Facilities chronically understaffed to protect margin create the conditions, violence, riots, lawsuits, that eventually blow the whole model up. The invisible cost isn't on the balance sheet, it's accruing in the yard. 2 case studies show exactly how this collapses, and they fail in opposite directions. The first is a story of market mismatch and operational friction. In 1997, the Northeast Ohio Correctional Center in Youngstown, run by Corrections Corporation of America, opened to house maximum security inmates transferred from Washington, D.C. Within its first year, the facility recorded multiple stabbings and 2 escapes. Investigations pointed to understaffing and inadequate training relative to the security level of the population housed there. The company had matched a low-cost operating model to a high-risk population, and the mismatch became a federal lawsuit and a public scandal that damaged the operator's reputation for years. The second is a story of capital structure and over-leverage colliding with policy risk. CoreCivic and GEO Group, the two dominant publicly traded operators, had restructured themselves as real estate investment trusts, a structure that required paying out the vast majority of taxable income as dividends to shareholders in exchange for tax advantages. That structure works beautifully when contracts are stable. In August 2016, the Department of Justice announced it would phase out its use of private federal prisons entirely. Both companies' stock prices collapsed by more than 30% in a single trading day. The REIT structure, built for steady income, had no cushion for a policy shock because the dividend obligations didn't disappear just because the federal contracts might. One company got the operations wrong, the other got the capital structure wrong. Both discovered the same lesson from different directions. A business built entirely on government promises has no protection when the government changes its mind. Here's the entire model collapsed into one equation: fixed per diem revenue times guaranteed occupancy minus chronically suppressed labor cost equals margin until the guarantee or the population disappears. Realistic net margins across the industry run in the 8 to 14% range on operations, thinner than most people assume for a business accused of printing money because staffing, litigation reserves, and compliance costs eat everything the per diem doesn't. The operator who mastered this system wasn't a warden, it was Thomas Beasley, a co-founder of Corrections Corporation of America, who reportedly pitched the entire concept to investors with the pitch that you could sell prison beds the way you sell fast food, hamburgers. He wasn't wrong. He built one of the largest correctional companies in the country on that exact premise. The system was never rigged to rehabilitate anyone. It was rigged to guarantee occupancy for the shareholder and leave the risk of an empty bed, a policy reversal, or an understaffed riot sitting entirely with whoever signed the contract.